Hello, hello, hello. Happy Thursday. I decided to do a live pop up event today and address a question that I recently discussed with a group of passive investors, namely, are pause distribution a sign of concern? Hopium, is my deal in trouble? So I'll share my thoughts on that today. But before we begin, for those who may be tuning in for the first time, my name is Vessi Kapulian. I'm a former commercial lender turned real estate investor. Today, I actively and passively invest in apartments primarily, and I also guide investors, business owners, family offices through the investment process, as well as help them review and evaluate deals. And for those willing to do a deeper dive or eager to do a deeper dive, I also have a private community of investors whom I guide through the underwriting process so they can evaluate deals with confidence and ease. So let's begin. As usual, the answer is are pause distributions a matter of concern? The answer is it depends. Now, it's never a great thing because usually why an operator would pause distributions if they're facing either liquidity or cash flow crunch or both. And so by pausing distribution, they're effectively slowing down the leakage or potentially stopping the leakage in an effort to conserve cash flow and replenish reserves. Now, the more important question to ask is what caused the pause of distributions? And that's where you find the answer as to, is that a matter of true concern? Is this a temporary storm that we're facing? Or is the operator just kicking the can down the road? Before we dive into that, just a quick reminder or refresher for those who need one is how we measure the ability to distribute is by following the paper trail or cash flow. And effectively, what you want to look for is the NOI number, then subtract from that the debt service, asset management fee, and any other expenses. And that will give you the cash flow before distribution. And ideally, you want that number to exceed your distribution payout rate. If it consistently is below the distribution payout rate number, whatever that number is, and typically the sponsor would share that with you in their communications, then that's an indication that the difference, right, is coming from reserves most likely. And then the question becomes, well, how quickly, right, are these reserves going to be depleted? So you always want to watch for that number, and then secondarily compare to the cash on hand. Ideally, you want to have a healthy balance there, and if that's getting depleted, that's also a matter of concern. But there are good reasons why an operator may pause cash flow. For example, let's just say they started on the CapEx project, and despite best efforts and despite their diligence, there was an item or two that popped up that requires more higher spend than was initially anticipated. Maybe there was a disaster that hit, and there are certain insurance claims that either they decided to file or didn't decide to file, but at any rate, there were repairs that were perhaps not anticipated and were above and beyond the original operating reserve, rainy day fund, and the CapEx reserve fund. Or like in 2022, 2023, even part of 24, when rent rates were rising rapidly and there were operators who either didn't hedge interest rate, and the lender was effectively impounding or asking them to escrow funds, so they have ability to purchase an interest rate cap at some point in the future or at the loan maturity date. And so those were some pretty substantial numbers because the cap costs increased exorbitantly given the volatility in rate, causing people to have to reserve a lot more than what they had planned for, and therefore leading to the pause of distributions. And so, if it's reasons like that that are maybe more temporary in nature, then I would say still a matter of concern, right? Because you want to watch the numbers closely, but you really want to get a good grasp of what from the operator, what is the action plan. Ask for a detailed cash flow forecast to see how long will it take us to get back on track. Now, if you're looking at a situation where there are operational issues or maybe they underwrote aggressively, I've spoken in many prior live events as well as the educational content I post about how many operators are coming into deals with very little or no reserves in an effort to show returns that are more pleasing on paper but come with inherently higher risk. Now, in those situations, right, where you had aggressive underwriting and or operational issues, then the pause of distribution is definitely not only a matter of concern, right? But then the question is, what's next, right? And so whether that's operational issues related to the top line where they aggressively underwrote certain level of rent growth that didn't materialize, or certain level of vacancy, or maybe they projected zero transition period and now it's taking 18 months to reposition and stabilize the asset, or perhaps their expenses were underestimated because they didn't account enough for payroll or insurance or tax adjustments and whatnot. It may be obvious to some of you, but believe me, I see that more often than I would like to. And so, yes, in those cases, the cash flow was overestimated, and God forbid if they didn't have the capex and operational reserves, then you also have to factor those in your free cash flow calculation, leading to potentially negative cash flow month over month. And so then it doesn't take much to do to the math, right, and figure out, well, if we're bleeding X amount of dollars every month, and if our cash balance is X, right, how quickly are we going to run out of money? And at that point, are we doing a capital call? Are we selling the asset, or are we going to lose the asset? There are a lot bigger questions to deal with at that point of time. And so you really want to understand the balance sheet and then the cash flow position of the assets in order to make a determination whether that's just a band-aid approach that's delaying the inevitable and it's full of hopium, right? Or is it truly a temporary cash flow crunch with very specific identifiable events and very specific identifiable business plan and cash flow forecast that shows you very, very clearly, this is what happened, this is why it happened, this is how we're going to get out of it, and this is the business plan, and this is why we feel it's supportable, right? You don't want a pie in the sky numbers that will make you feel good. So the short answer to the question is, are pulse distribution a matter of concern? Is it likely? Yes, but it depends. And again, you really want to dig into the numbers and the details I just shared with you in order to make a determination on what questions to ask, and then decide whether you should be concerned or not. So hopefully that was helpful for you. And I do these live events at least once a week. Sometimes they're more impromptu, like the one today where I just pop up randomly, and others are more scheduled. So follow me on LinkedIn and YouTube if you would like to get notified of those. If you do need help with a deal review or going through a capital call or pulse distribution situation, feel free to DM me. I do these reviews for investors, active or passive, very frequently. So happy to help you with that. And I wish you a blessed day. Ciao.